Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show.
Hey, thanks, Jim.
In the U.S., they're putting together a massive infrastructure program, $550 billion probably guaranteed. They wanted $3 trillion, but still an infrastructure program to look after things like bridges and roads and sewer systems, things that are pretty ancient in a lot of places and falling apart. Does Canada have anything similar?
Well, we definitely need to do a similar push. So do all major developed economies in the world, because over the past 40 years, really the focus has been on increasing consumption for the household sector, much more than increasing innovation or efficiency in production or reducing our waste. And so now we've really come to a point where we've had this massive period of underinvestment in the things that will help us with future growth and prosperity, and we've had an over allocation to the stuff that really just defeats us in the longer run. So, for example, all the consumer spending, what people really don't get often is that money borrowed, which is primarily what consumers do to fund their spending, money borrowed to fund consumption just reduces the amount of spending and growth that's available for the future. Whereas money that is invested in something that will lower your costs, increase your cash flow, that's the very nature of an investment, because it will actually improve prosperity as you move forward. So we've really got it completely backwards over the past 4 decades. And also the private sector, in terms of corporations, have been really fixated on how do we increase quarterly earnings, how do we do a sort of quick bumps, with no full cost accounting, of course, of the harm or damage that they're leaving for either the broader society or the broader environment. And all those costs are really catching up to us now. So we're having a lot of water shortages and problems across many places in the world. Obviously, water being a key infrastructure, not only for agriculture but for tourism. A lot of areas in the world are now realizing that they don't have the resources of the natural world that have become the big draw for people to come to their region. And so you're really seeing that an awareness build that because it's starting to hit in terms of the financial impact, it's really actually getting attention now. It's been impacting the health of people and, all kinds of species on the planet for a long time, but really as long as that was going on, but the financial side was still ticking along, it was largely ignored. Now we're getting to a point where we can't ignore it any further, and so the urgency, I think, is just going to increase over the next decade from here. And, the good news is that there are resources that we can allocate. We do have these really disruptive technologies in the key areas, which are the food system, the transportation system, and the energy system. And I published a link on the blog this week for the Rethinks organization, which is this think tank that basically aggregates all the various technologies that are available to help us make this big transition away from the 20th century infrastructure and systems towards the 21st and 22nd systems that are necessary, century systems that are necessary. So the good news is there's all kinds of blueprints done. There's all kinds. We have 90% of the technology that we need to make these transitions. What's been lacking is any serious commitment on the funding side. And so, every time, it's always the same old thing. Every time the serious discussion goes around what kind of money we need to invest to solve our constraints on resources and water and air and carbon and all these things that are have not been properly counted or accounted for. Every time we do the math, and you can remember, back in 2005-06, there was a major report came out of the UK talking about a global investment required of $600 billion, and everybody, went ape saying, well, that's just ridiculous. There's no way we'll be able to afford that. And, you think of it now, $600 billion sounds like a joke, Jim, to the kind of numbers that we routinely see in terms of bailouts for financial sectors and consumption sectors, which, as I say, we've really come to the end of that, both for a whole bunch of reasons. Not just that the math is running thin, to say the least, but also just in terms of, I think the human condition is evolving in terms of awareness that, there's only so much square footage and things that can make a person happy, and then certainly there's lots of people that have much less than they need, but there is an awful lot of people in certainly well-developed economies that have arguably much more consumption than is healthy for them. And what's really been lacking is this more future investment. So, I always say that an investment is something that, you're going to thank yourself for tomorrow having done today. And that's really what we have to focus on. So this is the first bipartisan effort of the U.S. is really a drop in the bucket. There's going to need to be trillions of this allocated worldwide, and it's going to be consistent over the next couple of decades. But I think, as I say, because the maintaining the status quo approach is becoming so obviously not possible, when you have all the natural world effects that we're seeing every day now, and when it's really curtailing the antiquated business models that people have been relying on, I think that's when you really get some attention and hopefully action, because we really can't kick the can down the road any further. So there's lots of opportunity in this, which is really exciting. There's a lot of talk about, all the QE and all the money pumping that's gone on to try and reinflate consumption in the global economy over the past decade. But really what happens is that, there's not a lot of, there's mostly a focus on the outgoing business models and not enough allocation or capital business models focused on the incoming business models. And so what you have is, they keep trying to offer credit to, for example, in the banking system. That's the central bank's approach, is they flood with liquidity to try and make reserves that they hope the banks will then lend for investment. But they haven't been lending for investment, both because banks are not going to just give money away if there's not a good prospective proposal or borrower that can pay back the principal and interest clearly. They're not in the business of just giving money away for free. But also because the appetite of businesses has been very low in this environment, where most of the incentives are still about these shrinking business models and non-sustainable things. There's not a lot of domestic demand for capital to go into new products and ideas. And so we really have to shift the whole thinking and incentives, tax system, everything towards these longer-term projects that will ultimately benefit us all in the future.
Some people are saying Canada should think about selling its water. Is that a good or bad thing?
Yeah, well, we're not managing the water at all. We do have something like 7% of the world's renewable water in Canada. Renewable, in the sense of that it can replenish itself. But we have a lot of water that was deposited, of course, from glaciers receding centuries ago, which is not something that will be replaced again anytime soon. And so Canada, of course, is infamous for using more per capita water than most countries in the world because we've been so taking it for granted, so to speak. But I think that, as things like the Colorado River is a shadow of its former self, like, the Mead Dam in, where is starting to recede so much. I saw a story this week about in BC how they are requiring groundwater users to register their application for licensing to continue in the way they've been using it, and a lot of the companies haven't put forth any application, which means that come March they're not supposed to be using groundwater in the way they have been for free. These are companies that use well water. And so this is a whole new thing because, again, once people start turning on taps or finding that they don't have sufficient resources, it'll sort of catch attention finally. And I think that emergency response will force us to manage our resource much better. And just blindly selling it to, for example, bottling companies, to sell us back water in plastic that we can't do anything with, this sort of thing. They've been taking that for a song for, the past few decades. That kind of thing has to stop, obviously.
Yes, here, the city of Surrey is selling its underground water for fractions of a cent per liter to Nestle, and of course they sell it back at $3 a bottle for a liter.
Well, these are the kind of business models that I'm talking about. The only way that business model can make any sense is Nestle says to the authorities, the municipalities, we'll create jobs if you let us take this water for a song. But if we do a full cost accounting of the amount of environmental harm and impact, of the plastics and packaging that's left over that we end up having to deal with collectively as a society, the pollution that's created, all that, and we would be much better off just investing in, access to clean water with appropriate recycling and controls on the amount that's wasted, and bringing all that to communities would be a much better use of that resource than allowing some for-profit models to take the gains and leave all the carnage for the rest of us.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, was the plan of the central banks to encourage companies and individuals to borrow money to power the economy? How is that plan working out?
Well, that's the plan of central banks always, is that they really only can affect the ability. They can't make people take credit. They can only make it available in the banking system through liquidity. So their sole function is to try and, control interest rates as a sort of a lock system, for the flow of money in and out of the economy. And once they're already at zero, which they are worldwide now in terms of their ability to cut rates is muted, and then they've resorted, as we know, over the past decade to this quantitative easing, which is, because banks don't have enough customers they want to lend to and or business customers looking to borrow, they just keep recycling their excess deposits. So they have a bunch of deposits from customers. They belong to the customers, and they're supposed to loan those funds out. Well, what they end up doing then is just buying government bonds with the funds because they can't find enough people to take them in the terms of productive loans. And so what ends up happening is that the central banks then in this QE has been going in and buying those bonds back off of banks, trying to take the bonds back and giving them more cash again and saying, here, borrow, make loans with this. And of course, it hasn't been happening. Credit growth has been flat now over the last decade, and I've been putting some charts of this on the blog recently because it's a very important feature of, this, like I said, there's only so much credit you can drive into a system, and then it just becomes superfluous, and we're not creating more ability to consume. We're just reducing our ability to consume because we have all these debt weights now throughout every aspect of the economy. And so central banks really are at the end of their efficacy in terms of driving any actual demand in the economy. And so that's all they have left. So now we really do go back to fiscal policy and focusing on how to improve prospects in the future by saving today, reducing consumption now, investing further for the things I was speaking of earlier. So really the focus has to be on fiscal policy. It's always been this way, by the way. There's been different times in history where monetary policy became, the go-to. It seems so much easier than actually negotiating for what kind of policies have to be in agreement in a democratic society. So the monetary policy stuff seems like a quick fix, and everybody's grateful when it works. But when you get to the end of it, you have to get back to the hard work of actually thinking and negotiating and investing in a democracy so that you have this strength building up. And that's where we are today. So it's actually, I think, better that we're here because the years and years of just cutting rates to drive more non-productive consumption really has been our downfall.
Inflation is officially running around 5%, and of course we know the government doesn't count housing or energy or taxes in that account of inflation. But the last time we saw rampant inflation like this, interest rates were going up to 21% in the late 70s, early 80s. Are we going to see the same kind of scenario this time around to cool inflation again?
No. So basically, the main concept that I think everybody needs to constantly remind themselves of is reversion to the mean. So what does that mean? It means what is the long-term average or mean in a particular series over multiple decades. Okay, so in the case of inflation, the long-term multiple decade range has been about 2 to 3% a year. And so when you get into periods where inflation is significantly higher than that, in order to restore that long-term mean, you have to have a period where inflation then goes back below that average for a period of time. And that's how you restore that long-term average over time. So the same thing happens with asset prices as with the commodity prices, with everything else. Home prices, a very good example of that is that, historically home prices have averaged about 5% a year. And that's over many decades. So if you look at, for example, the U.S. experience, just because the data is very available for that, but from 1975 to 2007, housing prices actually increased 6.6% a year over that period. So that was about 1.6% more annually than is historically the norm. So that really adds up. At the end of that period, housing was at a very high level relative to incomes, relative to rents, relative to, as I say, the long-term norm. So what happened was in that case was that housing actually mean reverted very severely over the next 4 years. With a national decline of 24%. What that did when you do the math now, as of 2011, that from 75 to 11, what it did was that decline in the 4 years between 07 and 11 restored the long-term trend back so that the gains over the 37 years from 1975 then were once again 5% a year. So that's how that works. It's one of the famous laws of investing that markets mean revert over time, and extreme moves in one way tend to be corrected by extreme moves in the opposite direction. So the same thing happens with the stock market. When the long-term average return in equities over a couple of hundred years has averaged 6%, and it has, but 4% of that came from dividend income that is notionally reinvested, which most people today don't reinvest their dividend income. They tend to withdraw it. Either it's used for fees within funds and managers, that's extracting that instead of reinvesting it, or people are withdrawing funds from their capital and then withdrawing the income and not reinvesting it. So they miss that the entire engine of equity returns over many decades has been this reinvestment of dividends, and a very small portion of it, about 2% a year, has come from the increase in earnings. That increase in earnings, by the way, reflects the long-term trend in inflation. Again, back to over many decades, the rise in inflation is typically about 2% a year. So when you get into those anomalous periods like the 1970s where it really overshot and interest rates really overshot, that was a very anomalous period, and it has been correcting to the long-term trend through years of disinflation, the rate of inflation going back down for interest rates falling over the long trend. So that's really correcting for that, as I say, that anomalous period where it drastically overshot. And the same thing now with the stock market, for example, where, as I say, the long-term trend's been 6% a year. In the last year, many things from the lows of March 20 increased 100%. We saw a similar thing in 1999 when the tech stocks increased 100%. And then what happens is that the long-term mean is still established, still there. And in order to correct that overshoot, it has to now spend a significant period of time coming down and staying below the mean. That means that returns expectations for the next decade are actually negative from these levels. And if that were to happen, if prices either fall sharply and spend a few years recovering again, that is typically how it's restored to this long-term return expectation. And so that's why I'm saying when people they're infamous for looking at the recent trend and dividing, drawing a straight line from there and assuming that that's the new model. But if that were the case, then, as I say, the long-term mean would no longer be a viable thing or a durable gauge to go by, and it always has been for decades. So I just think that people should be aware that when we've had these, when housing prices have doubled in the last 5 years, when the stock market has doubled in the last year, you should expect a period of give back where that excess return is all taken away. And in order to do that, prices have to spend a period of time below average returns, not just coming back to average returns. That's why people say, well, from here we should still expect that stocks will make 6 to 7% a year. They're totally missing the point that we're way above trend now, and that regression requires us to come below trend in order to get back to the normal mean.
In other words, a correction is really a correction.
Well, a correction is inevitable. It's part of the gravitational forces of these things, and that is actually healthy over the long run because trees don't grow to the sky, and housing can't go up 25% a year, and the stock market can't double every year. Otherwise, it'll become the only thing in the world, and nothing else will have any sunlight or access to capital or anything. It'll just take everything, and that's not the kind of system that we have.
Danielle, thank you so much for chatting with us.
Okay, thanks, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.